By the end of this video, we're going to be caught up with the story behind the numbers of H&R Block. Fun fact, H&R Block Way is a street made just for this company in Kansas City, Missouri. Two things in life are certain, death and taxes. As we ring in the new year, you too will have to pay your taxes. Shouts out to Benjamin Franklin. The income statement. Now here they've elected to include a special column. For our purposes, we're going to ignore this column. Revenue more or less flat, cost of revenue more or less flat, perhaps unsurprisingly, net income more or less flat. The balance sheet. The ratio of total assets to total liabilities is about 1. A company very much stretching its resources at this point. Statement of cash flows. Remember, we will ignore this transition period column for our purposes. Depreciation actually decreasing, suggesting that there's less baseline activity happening. However, they've actually increased their deferred taxes, which contradicts the idea that this business is somehow in decline. At the same time, capital expenditure is increasing. Is this business declining or is this business growing? The income statement literally showed no change, but every other row in these financial statements implies that there is change. I'm just not sure in which direction. So in conclusion for the opening move, step back and see if this business in decline or in growth. We will zoom in specifically on depreciation and amortization to figure that out. Searching in the item 7, management making the claim right off the bat that this company is in growth mode. Lots of Microsoft Word type arrows pointing upwards. Lol. A sentence hidden deep in their rundown of the latest year. Amortization just naturally ran its course. Drilling into the CFO's office note on property equipment, the only row that could be referring to an intangible would be this purchased software. A $700,000 decrease. Not really looking very crazy when compared to all these other numbers. However, the management's hint saying the word acquisitions can lead us to this note on goodwill, tracking their previous acquisitions. Here it is starting to make more sense. This row internally developed software. The net value is significantly smaller than the value last year. On average, the internally developed software that H&R Block acquires with purchasing new companies is amortized over 2 years. That's very short. And most notably, purposefully less than half the length of the customer relationships, quote unquote, putting down competitors and trying to do that while keeping the customer relationships intact. How do I know this is on purpose? Well, because if they were not doing it on purpose, then they would just shut down the software as soon as they purchased it. Instead, H&R Block takes on these amortization costs in order to keep the internally developed software of previous competitors running for 2 years and justifies that by also including an account for customer relationships that will last for 5 years. It's in the last 3 years that H&R Block expects that activity to be quote unquote profitable. Hey, if you're getting more comfortable uncovering the stories behind the numbers, please like and subscribe. Returning to the cash flow statement, this row for depreciation and amortization, apparently in the tax software business, this represents how many competitors H&R Block is quote unquote conquering, for lack of a better word. As this number is decreasing, spending less on keeping non-core software products online. In this particular case, it's kind of nice that it's decreasing. And also explains why deferred taxes is increasing, which would be the opposite of what would be expected. They transition into having those customers use the core H&R tax software, which actually increases revenue and therefore the taxes that H&R Block begins to owe. What at first looks like incongruent is actually just explaining H&R Block entering the latter stages of a lot of those acquisitions that they made a couple years ago. Returning to the income statement, we can now understand that that same story is playing out when this row, SG&A, decreases and services revenue increases. On top of making an extra couple 10 million, H&R Block also gets to spend a couple 10 million less. They benefit from both of those things happening. Before income taxes, you can actually see that they made, what would that be? That'd be about 52 million more in raw income. We now understand just shuffling around the customers they already had. A big part of that 52 million wasn't even them trying to acquire new customers. Then elected to pay this much in income taxes in order to make it look like, and I am going to say make it look like, they didn't make really any more money compared to last year. That's them using tax law to their advantage, I'm almost certain, by paying more taxes this year when they didn't really acquire new customers. It was just a shuffling around. It seems like they're actually expecting to get more income tax refunds than if they waited in order to pay taxes in a year when they were having to spend extra on marketing and all these other things in order to acquire new customers. And so the latest year looking so dull can actually be explained by a tax company, surprise, surprise, using the tax law, stretching the tax law, pay taxes when most benefits them. So by and large, H&R Block, not necessarily trying to get a lot of customers or really in growth mode, more in how can we pay our taxes as efficiently as possible mode. To be fair, I don't hate that. I kind of feel like, given what it is that they do and what they want customers to know them for, it's kind of cool that they've spent most of the last year doing exactly what we would want them to do for us. I'm not going to claim that I understand all the tax loopholes that H&R Block was alluding to in its annual report. I'm also going to sympathize with anyone who's looking at a higher income tax expense, lower net income, and saying, how is that good? I'm not super sure how it's so good. H&R Block seems to think it's good. Clearly H&R Block knows more about taxes than I do. I think that's a safe bet. And so making less money last year is good. I'm trying to wrap my head around it too. Please like and subscribe. Remember that this channel is all about hearing the stories behind the numbers, but then developing an intuition about whether these stories do or do not represent value in the current markets. With that in mind, please take a moment to guess whether this particular company is going to rank high or low in the season rankings so far. It helps tremendously to explain your reasoning to someone before seeing the ranking, if you are able. Do that now. H&R Block ranks 6 out of 76 in value for the 2023 season so far, making it into the top 10%. I'm now going to interpret what the Safe Seeds AI seems to be picking up on. Spewing money out every year. We saw the income statement, extremely stable, guys. Like it's shockingly like pegged onto the same sort of return on investment year after year after year. After seeing the annual report, I'm guessing that's a bit of a flex. I wouldn't be surprised if some of the people at H&R Block actually find it kind of funny or do this on purpose in order to keep their return on investment exactly the same by running circles around the tax code. But underneath all that, Sage Seeds AI highlighting that this company makes a lot more than the income statement seems to imply. Not necessarily growing at a crazy rate, but quietly, kind of low-key, snowballing exactly the way that investments should. This company is about as stable a business as you can expect, with a downside that is extremely concrete, something you don't necessarily find all the time. Let me know your reactions to this in the comments below. Part of me is kind of like, I should look into the tax code of my country a little bit more now. I'll probably just call someone like H&R Block later this year instead. I'm curious if anyone agrees with doing that. Share your wisdom, then share this video.